Let's talk about natural gas. So natural gas, started growing again, and it was good to see that we are a little bit ahead of quite a bit ahead of the pre-pandemic levels. Actually, for a few days here in the U.S., I think in the third or the fourth quarter, we produce more than 100 billion cubic feet per day. So that's a good milestone to kind of look at. We think, again, it's going to grow at a decent clip. But if you look at this chart and you try to compare it with the ranges that we saw in oil production, the range is a lot narrower, mainly because we think that the upside for greater production of natural gas here in the US is constrained now from the lack of infrastructure. We are running out of pipelines to move this gas out of the key producing plays. The chances of us finding or adding new pipeline capacity to that beyond what's already been announced is increasingly getting challenging. And as a result, that's having an impact on our ability to supply more. No big changes in the fact that a lot of this continues to be associated gas production. Historically, most of the Permian gas production is all associated gas production, and a lot of the economics of that production is driven by the price of oil, not necessarily the price of natural gas. I think we'll continue to see that dynamic. Although I think if natural gas prices start picking back up, as we saw last year, we would see greater interest in the Appalachian producers, which is non-associated gas to produce. But the problem is they don't have enough pipelines coming out of Appalachia, and that's the challenge. In terms of growth, again, the bulk of the growth is going to come from Appalachia. It's going to come from the Permian. But what is interesting is Haynesville's growing very quickly. A lot of the growth in Haynesville is driven by its proximity to the LNG export terminals that we were talking about earlier. But no big surprises or changes there. I love looking at natural gas break-even prices more than I like to analyze oil break-even prices, because it's amazing that the US can produce gas at less than $2.5, $3 a million BTU and still deliver a 15% return to investors. No other place in the world, except maybe Qatar, can you do that. Of course, break-even prices went up a little bit because I imagine because of supply chain issues, inflation, and all of that. But still, US continues to be very, very competitive in terms of natural gas production costs. This graph hasn't changed. Every year we update this, and there's barely any change in this graph. US has sufficient resources to produce natural gas at less than $3 to a large extent for the next 10, 15, 20 years. If we build more pipeline capacity, we can extend that out even more, and gas becomes a very successful bridge towards energy transition. And therefore, building those pipelines, building that infrastructure is absolutely critical. So where is all this gas going to go? This is a bridge from 2022 to 2025, and obviously LNG exports is the primary driver. The world needs a lot of LNG, so that's a good thing, that a lot of that is going there. Some of it will also grow in terms of pipeline-based exports, some growth in industrial capacity. If there's one chunk of this that we think is likely to grow more, that is that industrial segment, because there's a lot of industrial growth that we are seeing in the US. We expect that industrial growth only to intensify further because of the Inflation Reduction Act, because of the bipartisan infrastructure law. So I think a lot of the things that are happening from a regulatory and policy point of view are very supportive of further industrial growth in the US. There's still, this year actually, we're going to see quite a bit of coal-fired power plant retirements being replaced with gas and all of that. But I think that story is, to a large extent, has been written out. We don't think that there's a whole lot of growth there. Next couple of years are going to be a little bit of a slow time frame, probably except for Golden Pass and maybe another US project that will come up here. But after that, we are going to start seeing a lot of projects come up both here in North America, but also in other parts of the world, right? So if you are thinking about developing an LNG project today, you'll essentially be competing with a lot of other LNG projects that are coming up down the pike. And that's going to be a challenging time here because we think that LNG pricing will continue to stay volatile. The broader fundamentals suggest growing demand for natural gas, so we are fairly bullish on demand for natural gas. But the ability to finance these projects, the ability to secure counterparties who will sign 20-year sales and purchase agreements is not going to be, it's going to take a lot of commercial and business development work, because a lot of buyers are looking at this market and saying, I should probably wait before I sign on the dotted line and get the best deal possible in terms of these agreements. What we are also seeing is we spend a lot of time evaluating the structure and economics of these sales and purchase agreements in LNG. And what we are seeing is that sellers are now willing to accept much lower prices than what they were willing to accept, let's say 5 or 10 years ago, which also is another reason why counterparties are being slow in terms of signing these sales and purchase agreements. If you know that a lot of supply is going to hit the market in a few years, and if you can afford to wait, you're going to wait. And that's what we are seeing here. So going forward, we obviously had this run up in prices because of the conflict last year. We think that will come down. It has already started coming down quite a bit, and we think it's going to come down more. Actually, gas storage levels in the US are at an all-time high right now, and the general expectation is that if it doesn't get colder, or if there's if production continues at the current clip, we'll be out of gas storage by the summer, which means that some producers will have to curtail production, which means natural gas prices will fall. But our broad view is $3.5 per MCF over the next couple of years before it starts rising as the value and demand penetration of natural gas grows over the next few years. Of course, if permitting reform comes, if we can quickly expand and add new pipeline capacity, we think that demand is going to go up, and it creates opportunity for potentially a slight increase in natural gas prices. Globally, we obviously are beyond the sugar rush that we saw, $60, $70, $80 million BTU for gas in Europe that we saw the past year. Weather has been the primary driver for this. We've seen much warmer weather, and as a result, European gas storage levels are nice and comfortable. And as a result, we see LNG prices coming down. In fact, the strip's a little bit higher than our forecast, but we think essentially gas prices around $25 to $35 a million BTU over the next few years. And we also expect the markets to reverse back in a couple of years to the traditional premium for Asian markets relative to Europe. Of course, if the conflict takes a turn that we don't intend, or well, implicit in this is the fact that not a lot of Russian gas is going to find home in Europe. But if some of this changes, then obviously it's hard to predict. But this is our thinking today. What could drive LNG prices further up? China's reopening, of course, will have a pretty big impact. What a lot of people have not appreciated is that Europe imported about 40 million tons of LNG last year, and because of China's slower economic growth, it imported 40 million tons less than what it was expected to import. So the markets kind of balance themselves out nicely. If China starts picking back up again, you'll have to go find another 30, 40 million tons, and that's not going to be easy. The only way to avoid that is if warmer weather continues and some of the deindustrialization that we are hearing about in Europe continues, then some of the industrial demand for gas there is likely to fall. Other drivers, if global LNG demand grows and we see new liquefaction capacity coming to North America, but then, Jeff talked very nicely about this in the keynote, but that it's not going to happen overnight. It's going to take some time, and we saw all the complexities of building an LNG project, even when you have well-capitalized parents like Qatar Gas and ExxonMobil. Even then, it's a challenging thing. Asian markets, they have done a lot of fuel switching away from LNG. If some of that starts switching back towards LNG, that will have an upward impact on LNG prices. In terms of downside risks, again, economic recession is an issue. One way to bring LNG prices down very quickly is permitting reform. So if there's one piece of legislation that can have a pretty big impact on energy markets going forward, it's that. And then, if we see some growing reshoring of industrial capacity back into the US, as we have seen over the last year or two, that will also have some impact on European gas demand and could have a small impact on LNG prices.